Is a housing cold front approaching that will chill the multifamily market? Well, you'll hear it here on the Gray Report. We'll go over the forecast for multifamily and how it may be not quite as warm and sunny as we thought that it was a few months ago. Spencer Gray will give us some much needed insights from the recently finished NMHC conference. We'll get an article from the Wall Street Journal showing that home sales have fallen to their lowest levels in nearly 30 years. And in an article from Globe Street talking about how treasury yields and interest rates have cast shadow on multifamily hopes. But all is not as chilly or dark as it may seem. There are some sunny days ahead, of course, for the multifamily market. We're going to talk about Freddie Mac's new report that says that there are positive but moderate outlook for housing and the economy in 2025, and Fannie Mae saying that for the multifamily market, it's clear skies ahead. So that's really good news. However, you could temper that with some reports from the Conference Board on lower consumer sentiment. And then there's a little bit of a mixed bag here when we're talking about some recent numbers on consumer sentiment. And there is Marcus and Millichap's 2025 multifamily outlook shows some positive spots, some negative spots, and that seems to be where we're at right now. It's less of a clearly optimistic outlook for multifamily and more of a just another normal year. I think that things will be more positive, but we'll share all of our thoughts here on the Gray Report. Remember, if you are a multifamily insider or just interested in the multifamily market, the Gray Report is your source for the best and the most important news on the multifamily market, housing, and the economy. Let's get started. Back here at the Gray Report, I bring with me Head of Investor Relations, Blake Peroni. He has not yet been a Gray Report guest, but we needed him in, so we got him in. Spencer is currently still at NMHC in Las Vegas, and we're going to get some updates from him in just a moment. But yeah, I just want to welcome you, Blake, and I'll put you on the spot. What Spencer does to me all the time, and I never have an answer. It's like, how do you think the multifamily market's going? How have things gone for you, in the past week or so?
I think it's pretty. It's cool right now. I mean, I know the topic of this is cold front approaching, but
yeah,
that kind of assumes that it's not already kind of cold. It seems like it's kind of cold right now, and I actually thought it was de-thawing. A number of people have talked about that. Yeah. But this seems like it's maybe going to take longer to de-thaw, I guess.
That's a good point. It's like I think that there's a risk of being a little bit reactionary because of recent kind of realizations that have sunk in about persistently higher interest rates and things like that, where it's like, oh man, have we really hit the brakes on the multifamily market? I think that there's a lot of demand drivers, or call them housing demand or economic growth that's still going strong in 2025, and still I think we're in a better place, all things considered, at the start of 2025 than we were at the start of 2024. But there are certain things I think, like maybe the potential for distress or some other multifamily lending specific things where there's a little more uncertainty, maybe a little more anxiety. I was surprised that Spencer had said that distress is actually people are still talking about it now. We'll have to. On the Gray Report next week, we'll discuss how much it may have increased or decreased from last year. I get the feeling from the way that he depicted it that a lot more people are talking about it now than they were then. But that's that kind of leads us into maybe we'll look at this. Let's exit here. We'll look at Spencer Gray's posts on his post on the NMHC Strategies Conference 2025. This is a summary from his notes, as well as he turned the ChatGPT microphone on and he summarized it with ChatGPT 4.0. So that's why you see the graphic, like kind of emoji bullet points. Just word for the wise. If you're looking for AI, look for those little emoji bullet points. I see them a lot.
That bottom one. That's
bottom one is like
dead giveaway.
Because no human's gonna scroll through and make
true.
each bullet point carefully picked. But that's neither here nor there. I think that some of the stuff that Spencer has identified here, and this is again coming from his notes, as well as I'm going to dip into a couple more, maybe at least one more post from Spencer earlier, really isolates some very interesting things that are happening at NMHC. So one, People are acknowledging the regional performance of the Midwest and Northeast. Sunbelt markets face this oversupply challenges. That's not really a revelation, but it is important to note here. And I think that it's interesting. The workforce housing demand remains strong. I think this is going to be interesting because of the way that new supply affects the market, and people say, well, we need more workforce housing, but the way that new supply comes in, and it will affect the rents in a cascading way, the B class, C class, and all that, those rents are going to come down. And what happens what has happened in the past is I've heard these discussions, and there was one on Spencer had with a few multifamily investors on Marcus and Millichap's 2025 forecast web conference, or maybe it was an Outlook, I forget. But they talked about how some of these C-class assets may not have buyers, or maybe the distress will be in like older buildings that are maybe a little less shiny and new, or maybe a lot less shiny and new, and it'll be difficult for them to find a buyer. I wonder how that's going to shake out if they're not already a sought-after asset. How much that's going to move the market, or will it encourage investment from people that typically have nicer assets? They just see those prices so low and they're willing to invest.
Yeah. The distressed word that's thrown around it could mean one of many things. It's like maybe you have no buyers for your asset, or maybe you financed it wrong, or something is going wrong, and people just kind of throw distress out there to mean any number of things. But I mean, I can see it even from us. We don't really consider too much C-class stuff anymore. Really ever have. Yeah, I mean, it makes a lot of sense.
It is interesting too. Yeah, what you said about distress and how there's not necessarily like a textbook definition, and there's also things that are just distressing.
Exactly.
And that's going to happen the same time that you have like whatever technical definition of distress is. I do think that it's interesting. There's a signal maybe that interest rates, debt payments, loans, lending environment, all of that is going to create a problem perhaps for people that currently have loans for multifamily. It's a small subset, but I think that they could be under stress while they're also under distress.
Yes.
So capital market, they're talking about institutional equity largely sidelined. I think that this is interesting. Again, this is another follow-up question for Spencer next week is about foreign capital. I think we already have seen private capital stepping in terms of maybe individual investors or smaller investors than the big guys with the funds and everything. They said debt is liquid, underwriting more cautious. Definitely have seen that. We're fairly disciplined as well. I wish we were less disciplined, and so we could have a bunch of deals. But unfortunately, we are disciplined, and we find our few really great deals that we go on to market, and we get investors for them, and it's working out pretty great for us. But there are some institutions that aren't finding a single one. I'll talk about this in a few minutes here when we cover some more articles from Marcus and Millichap. But the idea of dry powder is always like so weird. It's like there's always been dry powder. It always seems like everyone's always talking about the enormous amount of dry powder, and I never see it really go anywhere. It's always like earmarked for like this super special condition of like super returns.
Yeah,
and so
exactly.
It's not really
that never ever really happens.
Yeah. And I like the acknowledgement there that this institutional equity is largely sidelined because it's sidelined. It's either going to act or it's not. Don't tell me how much dry powder you have. Tell me if you're going to use it, because it might as well be flour or whatever. I don't know.
And it seems like people talk about dry powder a lot, and when you have the hindsight to be like, oh, that was the bottom, I should have gone in, it's too late. You know what I mean?
No, that's a good point.
Like, I think for most people, it makes sense to always be investing.
And I think too, I wonder if the dry powder, it's not like it's been sitting there for 3 years. It's cycled through. It's, there's just a surplus. Development challenges, that's something that we will also be tracking here. There's a great chart from Fannie Mae that shows how in the wake of this reduced permitting, how the deliveries may be falling off to the levels of like 2014 and 2015 in as soon as Q3 of this year. So that's like a big fall off in building. That's going to translate to a little bit stronger asset performance. I don't know what the lag time is, so that's going to be interesting.
I wonder if we could give each year like a theme of in the multifamily space, and in 25 I don't know. I don't know what it would be yet, but 24 definitely seems like the loans are getting reworked, things are getting pushed down, which is kind of the same as 23, pushed down the road a little bit. In 26, I feel like this is looking pretty far ahead, but it could be this supply and demand shift because the demand is just incredible. I mean, we've seen insane demand in 2024 for multifamily housing, and exactly to what you're saying, as development kind of falls off a little bit of a cliff or kind of goes down to a trickle. I think 2026 might be, that might be the theme of 26.
That's a good point. Like we'll be firmly in like a kind of new landscape. All of the articles that we're going to be covering here, they reference something more or less like a balancing of supply and demand. So we'll probably like crest that hill, and then we'll be firmly in it. Once we're in 2026, it'll probably be a unambiguously strong rent growth, barring any kind of economic slowdown. So. Yeah. When it comes to value add and distress, like we were kind of talking about, pre-2000s assets face skepticism due to high capex and tenant migration to Class A. But in the best opportunities, mismanaged assets in strong location. Notice that they don't say like Class C assets or older assets. It's just maybe good assets that are mismanaged. I think that's a good case. However, like I don't have a compass or a dowsing rod that shows me which apartments are mismanaged.
I like this phrasing specifically, like use pre-2000s assets face skepticism. So it means that there is still good deals that are older and maybe B or C class in the 80s and 90s, but it's just you have to look at that with an increased level of skepticism for sure, which is I like the way that this is ChatGPT framed this or the way that Spencer framed this.
Maybe that went through. Maybe he wrote skepticism and they kept that. Who knows? I was just going to say, good job, Chat. Good job, GPT. And then also regulatory risk with rent control and tax policies as wild cards. And they're talking about prioritizing landlord-friendly states and tracking local policies carefully. This could be interesting. I think that there's also obviously regulatory risk on the federal side, or deregulatory risk, however you kind of want to put it. There's a lot of uncertainty there, and I don't want to say it's not worth talking about, but it seems like it's just generated a bunch of question marks and uncertainties at this point. There's not a clear direction like there is with apartment supply, or even really, I think there's a compelling case to say like inflation, it's generally trending down, despite like a couple ticks up. There's ways I understand that more than I understand the policy directions right now. That's like 10 working days into the Trump administration.
I like a lot of the framing of, I guess, this post and the words used, major wild cards, because I would think with a new administration too, I would actually think that this risk would be less prevalent as it might have been in the previous administration.
I agree too. I was going to say like I don't think that there's going to be more restrictive rent control or more restrictive tax policies, at least on the federal level. Now maybe they could have there could be like some kind of reactionary thing by local governments making other policies, but I don't know. That remains to be seen too. Big uncertainties, pretty big wild card. And then their bottom line, I don't like a year for selective, disciplined investing, focus on markets with supply, demand imbalance, alternative capital structures, and operational efficiencies. I don't know. That's still a little too general, but it's okay. I would love now. Again, this is not. I don't have ChatGPT in front of me, or at least the notes that Spencer used. But I'm most curious, and this question will come up, and I'm sure I'll be thinking about it throughout this episode of the Gray Report. What's the difference between this year and 2024? So much is the same, and only recently it seems like things have seeming more the same than they were. So maybe later in 2024, when we were a little bit more optimistic about 10-year treasuries being lower, it's going to be clearly better. But now we're facing some very similar pressures from interest rates as we were in 2024. However, on 2025, the supply demand, the market fundamentals of the multifamily market have unambiguously improved. There's no way around it, and you can look at the trends. Trends are pointing in the right direction.
Yeah, it seems like 25 is somewhat similar in terms of like the interest rate environment, maybe a little bit worse, but the supply demand metrics that you talked about seems like it's it seems like right now it's going to gradually get better towards the end of the year, at least for the sponsor side.
Now, this is a question from, because you talk to investors a lot. Where do you see it falling? Do you notice any? Because we had a deal, I think, right, in early 2024,
and we close in April.
Yeah. So we closed in April. So I'm curious, how does the sentiment from investors today differ from
24?
Yeah.
I think it's maybe mostly the same with with just a one tick more skepticism, I think, or like want to dig through all the numbers a little bit more, which is totally fine. We're happy to provide that kind of thing, but I think they just want to think that they're being more thoughtful in their like due diligence of investments, which is, I mean, you should always do that for any investment. While really 2022 was the year that like real estate's going up, it's gone up for the past 2 years, it's going to keep going up, and like people were just kind of throwing money into every deal, not just ours, but like all kinds of deals. And it seems like it's just a little bit more thorough, I guess, in the investing from the conversations that I've had.
Yeah. Okay. And that seems to be it's this kind of qualified optimism,
which I think is a good thing. Like as an investor, you're putting $100,000. Yeah, you're putting $100,000 into something. You should probably know it, like,
for sure,
at a pretty deep level.
And I remember going over the numbers in like 2021 and 2022 when rent growth was growing like crazy, and thinking like, okay, something is a little bit wrong here. There's something that's out of whack, and valuations started going up like crazy, and you kind of get this sense as like, all right, this is a little bit detached.
Right.
But now, and much as probably as it will be in 2025, I think fundamentals may improve, may make things a little bit easy for apartment operators, but on the buying side, the sales volumes could be very similar, which is annoying.
And actually, the other thing that I just thought of, I had a few of these conversations with investors that have actually told us that they are holding off because they are holding on capital for capital calls from other deals from sponsors. That aren't necessarily going that well, but they're not totally kind of, writing to zero or just kind of kicking to the side, that they are still kind of hopeful that the project will work out long term, but they need to retain capital in the event that the sponsor calls them and said, hey, we need a little more money for this, or to reach out another 12 or 14 months.
So that's interesting. And that also implies, a more pervasive sense of like realism about where the market is at. And I wonder if that's going to translate to lower asset prices. However, all of the reports, I couldn't find a report that has that is like contradicted it. All the reports suggest like cap rate compression. But maybe in these select opportunities, you could see someone that's motivated. That's like, because people are accepting maybe there's not going to be a quick fix to this.
Yeah.
We've lived with high interest rates and kind of difficult times relatively for the past couple of years.
One of the things I hope happens this year is that there's like a continual divergence amongst really good quality sponsors and the sponsors that kind of threw money at anything in 21 and 2. It seems like that is happening, and a lot of the LPs are getting really frustrated with the properties that aren't distributing. That they've put money into in the last 3 years or so. And I think that certain sponsors are going to start to get a negative or a more poor reputation, which I think that there should be a more clear way to kind of gauge the quality of a sponsor.
Well, because I thought about this, and maybe I've discussed this on the Gray Report, is like, there are plenty of people there are plenty of investors, and you get a bunch of investors by promising very good returns unrealistically, but maybe you believe them or maybe you not, and you get a bunch of investors. Turns out the investment doesn't go great. But people say, like, there's like this P.T. Barnum kind of thing where you don't want to admit that you're the victim of being a sucker. But I also think that the length of a multifamily investment period is such that you may not know that you're a sucker until closer to the end, especially if you're going to make money on like the sale of it.
Yeah, and it might not be like the sponsor as a whole. It might just be like a couple deals that maybe they didn't put as much due diligence into as they should have. Yeah. And I think most of them know certain decisions that they might have made that were maybe less than ideal. But I think they're kind of pushing it down the road in terms of talking or communicating to their LPs, because it hurts them for raising capital for newer deals that they might have. Yeah. And so, you don't want to say,
that's what I'm hoping.
Hey, these projects aren't distributing. They're not going well. They're, maybe you'll get your preferred return back, maybe, but you want to do $100,000 at this other deal that I have in Texas or whatever. Yeah. And so Yeah.
No, that's a good point. And this is the one that really caught my eye. It was earlier. Spencer made this post, said, there's a vibe shift at NMHC this year. Talk is not whether there will be distress, but how to navigate. Seems to be darker. Sorry, because I like this dramatic quote. Seems to be darker. It always does before the dawn. I do agree. Like that colored my whole approach to the notes, and as I was gathering sources and stuff, and so maybe there is a little bit of a bias, but it's clear that there has been a perspective shift from later, maybe let's say Q4 2024, and now we're in Q1 in 2025. It's like I think I wrote it in the notes, like from late fall of last year to like the winter, things gotten a little more chilly for the multifamily market, but I also think by focusing on all of that, I want to kind of front load this a little bit, and as a way of saying, all right, so we kind of know the bad stuff, then we can get to the real good stuff.
Yeah.
And it's not, and I don't think that they detract from each other. There's lots of good positive stuff.
It's not even the bad stuff. I mean, it might be bad if you're an LP that's in some of these deals, but it's really just like being transparent on what is happening out there and kind of showing the landscape of the multifamily space. And it just kind of it is what it is, kind of.
Yeah, I agree. So I want to get to this. It also touches a little bit on sentiments of the multifamily investment. And again, we'll hear more from Spencer Gray next week on NMHC. And I think he's got lots of conversations he's taking part in right now. And so I always love the little specific examples. It's like, all right, this guy's kind of thinking a little bit what I think. And we have kind of one specific example here. This article is from Globe Street. It's titled "Treasury Yields and Interest Rates Cast Shadow on Multifamily Hopes." Really, it's based around a discussion with a single guy, New Point Real Estate Capital's Marty Freyer, Senior Managing Director on the company's origination team, who says that if the 10-year comes down to 4% and stays there, then it will be a good year. If the 10-year stays where it is today, 4.5 or 4.75, it's going to be an anemic year. A lot of people can't sell above a certain cap rate number. Seems like the conditions that we're at, right? Is that there is pent-up demand. There may be dry powder and all of that kind of stuff, but they're waiting for interest rates to come down in order to be released. Yeah. I like to think in terms more of like pent-up demand than dry powder. It just seems like a little bit... could extend to the individual investor and especially to kind of the brokers that are surviving on real estate transactions. But you just look at the sales numbers and sales activity numbers. Things have been slow, abnormally slow, and whatever made the market function with higher numbers, that's not happening now. And so there's a big sacrifice there. He does it. So I think Mr. Freyer is right here about maybe the outlook for the market. I think that it's a big question mark. I don't think it's a done deal that inflation's going to stay high and interest rates may be higher for longer. There's ways for it to move, especially considering like the longer term trend of inflation has been down a little bit. So that's just one thing. And also, I do kind of disagree with Mr. Fayer's take on distress. He says the story of distress isn't going to be out there. Here, let's see. That's going to be out there in the multifamily space hasn't manifested. So distress hasn't come. It kind of feels like last year and the year before. Everyone has very little conviction, not convection, about what the year was going to look like, either on the debtor side or the value side. I don't think Fayer said convection. I think that was just a miss. However, the I and the E key are relatively far away on the keyboard, so who knows? Maybe someone was writing a recipe at the same time that they were writing the article, and they're like, convection. Well, anyways, everyone has very little conviction about what the year is going to look like, either on the debtor side or the value side. I think you just have a very moderately optimistic outlook. So these things are going to go the same, maybe a little bit better. He's saying distress didn't happen last year. Why is it going to happen this year? And and I don't know what would your take be on that? Because I have a big take.
My opinion would be that the distress is and always has been like spotty.
Yeah,
and that there isn't going to be nationwide distress of like every sponsor's deals are underwater. Mm-hmm. I think there definitely is distress, and even just talking with some of our LPs and some of the other deals that they're in that are not with us. I mean, they're having capital calls. Some of them are on their second or third round of capital calls. There is somewhat significant distress, but it is spotty. It might not even be on that entire sponsor's portfolio. It might just be on like, 2 of their 20 deals or something.
Oh, okay.
And so I don't think the country is going to be blanketed in multifamily distress.
Yeah,
but I think the prevalence of how frequent it is going to increase slightly over the next year.
Yeah. Good point. And I think now the fact that it's increasing is worth noting, and that's a good point. We have done research reports from Gray Capital on like a wall of multifamily loan maturities. I bet it's more of like a gradual wave. It's not just it's just like it's going to be a lot more gradual than just like suddenly not happening one day and then a bunch happening the other day.
That's how that's my opinion. I mean,
and I
could
think,
be wrong, but
and like we'll see, and there's a chart in Freddie Mac that shows delinquencies. Now it's not a 1-to-1 relationship; it's delinquencies for other types of like mortgages and stuff. So it's not perfectly like captures all of multifamily debt, but like they're slowly going up.
Yeah,
and there is a case. Now this would be the more dramatic case to say maybe there was so the loan started in 2021. You got a really good 2-year loan. And then 2023 comes around and you want to extend that loan.
Yeah.
And then you extend that 2 years. Now 2025 comes along, and now what are you going to do?
Yeah.
You already been extended once. Are you going to do it again?
Yeah.
I don't know if that requires a lot of things to have happened specifically as I describe. It's almost like a worst case scenario, but it could be. It could.
I think some of the problem is with not quantifying the level of distress, or like distress is such a blanket term, like we talked about, and it's not like at what point is a property in distress?
Yeah.
If like you have to pause distributions for like 3 months, to build cash or to turn something around, like not necessarily.
And in that way, it's has a more persuasive effect on the multifamily market as kind of a drag for investors that are just like seeing, or even operators, just like a big drag on their assets and on their investments and on the opportunity to invest in more things. So that's really interesting. I wonder, like you said, if the appetite for investment is slightly reduced because they're paying off existing, and there's just not enough money to.
I would say that's one thing, and
that's what the Fed said. I think is like if you keep these old bad loans alive by extending and pretending, then you're decreasing the opportunity for them to make new loans that are good.
Yeah. This is just my opinion again, but we're talking about opinions. I think that's one thing, and I also think LPs have realized how well their public equities have done in the past 2 years. I mean, the S&P in the last 2 years has just ripped through it, and they're getting a capital call on maybe one of their 5 allocations towards real estate, and they're like, this real estate, I'm going to reduce the total allocation size of my portfolio towards real estate, and there's putting more in public equities, which is totally understandable.
Yeah, that's a really good point. There's like this, it's not just how much money you have that you don't have. It's just like your whole attitude is probably different.
Yeah, and your experience on the last 2 years is probably either gonna slow or increase where you put your money towards.
Yeah. All right, let's move on to this other article that is from Wall Street Journal, talking about U.S. home sales at their lowest level in nearly 30 years.
Ugh.
Now, I'll bring up a chart that says that may not be right, but I think the major point is right. This is the corollary really to the anemic sales activity in the multifamily market. The relative stasis of home prices has kind of obscured this fact. It's almost as like, low home sales, but really the prices haven't really changed at all. And I don't see a whole lot of national level articles that are like this from the Wall Street Journal talking about the kind of coolness in the home sales market. If anything, they're still talking about high home prices. That was that was in the campaign just a couple of months ago, and it's still prevalent today, and that's still part of Trump. Trump promised also put out an executive order saying we're going to get this under control. Yeah. So that's nice. But we're still talking about high home prices. No one's really noticing how much the sales activity has really fallen off, and that's big for commercial real estate, multifamily, and single family.
Yeah. On the single family side, it seems like there's a very narrow band that we've kind of operated in terms of sales volume in the past year or two. I haven't seen any specific. Here we go.
So now this is a little it's a little confusing here, but you have this solid blue line that's at the top that represents the total home sales, and it is about, let's say, 0.85 million, so 850,000,
on a
something like that.
percentage basis, this doesn't seem like it would be that big of a change. No, from
Oh wait, I'm sorry. It was a little more than 4 million. So the actual number is 4.24 million total home sales in December. That's the highest level since February 2024 on a year-over-year basis. Sales were more, but total sales in 2024 fell to 4.06 million. So that's what we're talking about.
Yeah.
And the point in the article in the Wall Street Journal, and the point that NAR makes in a separate post is that, hey, it's never been this low ever since 1995. Now the graph, NAR doesn't have a graph. Wall Street Journal doesn't have a graph. NAHB doesn't have a graph that goes back to 95, but you don't need it because you can look and you draw this little line and it goes back to 2010.
Yeah, that's what I was wondering. Is like I can't imagine that it's lower than.
So that headline lied.
Shocker.
But like with some exceptions. So I guess the exception is like a few years outside of the great financial crisis and the home.
Excluding these periods.
Yeah,
it's the lowest it's ever been.
Yeah. But I still totally agree with with the larger point, which is we're not selling a whole lot of homes. Yeah. If you look here, since basically 2022, we have downshifted significantly from even pre-pandemic. So pre-pandemic, pre-pandemic maybe selling 5.5 million every year, and now post-pandemic we're selling maybe 4.5 million, if that.
Right.
That's a lot. That's like 20% cut, maybe if not more or less, whatever. Still a lot of that was reduced. That sales activity was reduced. As much as we pay a lot of attention on apartment sale, like we just talked about, the really anemic sales activity, it's about the same thing in the home market. And even so this is even worse than it ever was before. There are we'll see in a couple charts that say that maybe apartment sales actually is about the same as it was during the 2010s. So I'll pull that up. I still think that it may be a little worse than that. But the big point for this whole kind of larger comment, whether it's home sales or NMHC, is that interest rates are stubbornly still, a big point, a big mover of the market, and they could stymie a little bit of things. We're getting up to a point, especially, housing demand is not as roaring as it used to be, and so, things may be a little more vulnerable to to reduce demand because of high interest rates.
Back on the opinion piece of like the interest rates and stuff, like I'm at the point where I'm just going to assume that these are the interest rates. Like people say higher for longer. Like I'm not really waiting for anything to come down at all. Like I'm in the 5 to 7% mindset for the foreseeable future. And I don't even.
And that's what I wonder too. So there's a lot of things, lagging effects of interest rates, whether it's these extended pretend loans or whatever, or just like a realization that sets in.
Yeah, I think the best way to think about it is probably have this is the baseline, this is what the interest rates are for the foreseeable future, and then you can leave the upside if they do get cut. You're like, I wasn't expecting that. Not like checking every news article of like, when are interest rates going to go down, or you know?
Yeah. I agree. So you just have to accept it, and that's what I wonder is happening in the multifamily market, or could happen, is like people just need to get off the sidelines, need to acknowledge like I've been waiting for 2.5 years for prices to change or to conditions be different, but they've been the same.
Exactly. I think, and I don't want to speak for Spencer, but I think that our outlook on this stuff is like, if it's a really good asset and a really good location, growing market, all of the things that we look for, and it works with today's debt, which 99.5% of projects don't, then we're just going to go for it at today's rates. We're never going to factor in, but if interest rates come down in year 3, 4, and 5, then this deal will be great. Like, no, we're just going to leave that as potential upside. Just fix your interest rate today, and if it works today, great. Like,
yeah, no, I agree. I'm pulling up. I'm just because I had this set up on as I was doing the notes, and I figure I'll just pull it up here. It is inflation, Fed funds rate, and the 10-year treasury. So depending on which loan you're using, the multifamily industry uses the benchmark rate. Is either the 10-year treasury or SOFR, and SOFR is really closely correlated to the Fed funds rate. But these are two interest rates that are a big deal when you're thinking about multifamily loans. And I just think it's interesting if you just look at the Fed funds rate. They start to cut, and then there's a recession. They start to cut, and then there is a recession. Are they going to start to cut, and then there's a recession here? And most of the time, the 10-year Treasury is on top is above the Fed funds rate. And it has been below this. It's almost the same thing as the 2-year, 10-year kind of yield curve inversion that people talk about. Well, now we're getting to the point where the 10-year is advancing above the other one. Yeah, looking at the lines on these graphs now, I just wanted to illustrate a little bit of like, all right, well, here's the way that the economy is going. The general long-term trend is for lower 10-year treasuries over time, but it's gone up in a little, recently. And the general trend in same thing for the federal funds rate, whether you're talking about 10-year treasuries or federal funds rate, these two interest rate benchmarks have decreased over time. My question is, are we going to settle in to where, all of those numbers, whether it's inflation, et cetera, are going to settle in around 5%, or is it going to be, it's going to be like 2 or 3% like it was in, post great financial crisis, that like 10 years or so of low rates, or is it going to be more like the early 2000s? I don't know, because right now the motion, the kind of several years of increase in the 10-year treasury contradicts a longer term trend that, like, I don't think it's gone and stayed high in the same way as it has recently since like the late 70s or early 80s or 80s or something like that. So, but on the other hand, and this is, again, like, I'm kind of speculating here on the economy. On the other hand, we haven't seen inflation as high. So there's just so much that is up in the air when it comes to interest rates. It's dealing with a lot of things.
I don't feel like this is a very productive exercise to try to guess where. No, I'm not trying to.
No, I know. No, it's fine. It's fine.
Because nobody knows. It's just like nobody knows, and I think safety and just to take the base case of that this is where interest rates are.
No, that's a good point. You can't predict the future. You can't predict 1 year out, 2 year out, whatever. No. You just have to trust in the, like, what did it say at the bottom line? You got to trust in the asset selection, selective discipline asset. Focus on markets with supply demand imbalance. I'm going to say focus on assets that are really good too. Yeah. And make sure that you've got those operational efficiencies, that you're running everything right, because it's not going to be easy this year. I will still argue that it's going to be easier this year than last year for the apartment industry. However,
I wonder if there has ever been a year where it has mattered more about the actual sponsor versus the asset than the past, like 2024 and 2025. The profitability or the success of the deal seems like it has been entirely on the shoulders, or almost entirely on the shoulders of the sponsor. I mean, you could mess up a deal pretty bad by what you do on the front end, but once you're kind of locked in, I feel like it's never been more important to pick a good sponsor. And I'm not just saying we're the only sponsor out there that is doing
wonder how you get that information, because no one, if you're doing bad, you don't want to, but there probably could be ways of figuring out, like, if we know who's operating a certain asset, and we can look at the rent growth that's reported there, that may be one way of doing it. But it may require some, like, you got to get the backdoor access to RealPage. I don't think you got to be and I think the research that would come out of that would probably be like, it wouldn't name names, but it would be like, here's the real variation of assets, Class A in the same market, similar everything. There's this weird differentiation that would it'd be totally interesting to see what to look at. What were all the good sponsors doing? What were all the bad sponsors doing? And really, really good point. And I really do appreciate too your perspective, because it is always something that I do think, and I always kind of chastise myself. I don't want to talk bad about people, but you're seeing this every day from people that are saying, actually, no, we got to clean up some of this mess that was made previously on a bad investment. And so, it's not, and it may not be bad investment, but it just may be, there are difficulties that other people are having. And let's hope that it doesn't sour people on the prospect of investing in multifamily in general, because I think that there's a strong case to be made, and Freddie Mac is one of the people that are making it. They have a positive outlook for housing and the economy in 2025. The quote is, despite the rebound in mortgage rates, housing activity picked up slightly, indicating that home buyers are ready to come off the sidelines. There's the sunny take there. Elsewhere, we've already read that U.S. home sales in 2024 fell to the lowest level in 30
Yes,
years.
I'm a little confused that housing activity picked up slightly.
I love when I get the Freddie Mac and Fannie Mae like monthly reports, one on top of the other, because sometimes they do cover very similar things, and this week is no exception. And Freddie Mac is always more optimistic than Fannie Mae, and they are at this point though, they are more optimistic. But it almost seems like Freddie Mac is spinning something, and there's some data that you dig that makes you be a little more skeptical, makes you maybe think like a lot of the people at NMHC are thinking right now, like, maybe some clouds. I think that expect the U.S. economy to grow at a positive but moderate pace in 2025. I think that's the same thing
that's a good take.
Yeah, for housing, for multifamily, positive growth but moderated.
Yeah.
Let's see, there's some graphs that I want to talk about here. Primarily, it's this graph on the total seriously delinquent loans by loan type. I referenced
seriously delinquent.
Yeah, okay. I didn't even notice that.
Not the ones that are delinquent, but these are the ones that are seriously
Yeah, so I'm
delinquent.
skipping ahead. I'm not reading part of my notes because I was excited to talk about this. And it shows for the this is how many as a proportion of all loans, and then conventional loans, FHA loans, and VA loans. And they are all, this seriously delinquent, they spiked in, I guess, like around 2021, a little bit after that first pandemic year, kind of. So maybe early 2021 with the pressures peaked then, and then rates fell down, and so too did the seriously delinquent loans, almost seemingly bottoming out around in 2024. But there is a noticeable uptick. There's a small slope, but it is noticeable, especially for FHA loans. But
what happened to FHA loans in 2021? I mean, they were higher than the 2008, 2009.
So I wonder, and I really want a lender, maybe Marty from Real Point Capital can comment here. Marty Thayer that we talked about on the Globe Street article. But my thought is this could be part of there's a lagging effect between maybe how you're doing on your loans and the performance of the economy. That big, the economy took a dive in 2020, the shutdown period, and then that's that whole like flash recession that you see on all the charts. Yeah. And then they just shut up until it looks around 2021. People are still feeling that effect. That's what my guess is. But
I have
it is weird.
Serious skepticism of this graph. And I don't know what seriously delinquent means.
Yeah. Okay. Well, that's true. It's a little clearer to me than maybe the existing home sales, where it's just like, all right, those home sales aren't what you're reporting. But my point is, I'm just looking at the general trends here. Now, I'll take out kind of digging into what the timing of the spike in seriously delinquent. But it does look like, no matter how you slice it, all of these loans are
coming back up.
They're coming back up. The delinquencies it's getting harder for borrowers to pay their debt. And it hasn't been a situation where they all hit a wall and now they're okay or they're horrible. It's just like it's getting worse, it's getting worse, it's getting worse. And that continued pressure of high debt payments, that's I think a lot of this is single family. I think it's true for multifamily as well, and for CRE in general. And so that's the image of the debt market and of paying loans that would maybe counter the idea that distress is not going to be a factor. I think it's still going to be a factor, although I think your perspective that you shared about how it doesn't necessarily mean that one man's pain is another man's gain. One man's distress could mean that, you're sitting pretty here, but that just means that's one less investor because he's probably or I don't know, bailing out that loan or something, or now he's disinterested.
Wonder, when we're talking about distress, what is the depth of it? How hard is it going to cut on some of these sponsors? Because there's, like you said, dry powder on the sidelines, but there's buyers that want to buy these things, and there's enough buyers on the other side that once you see a good deal, you start seeing 6 or a 7 cap. That deal's going to go like crazy. If that absolutely crushes the sponsor to sell it at that rate, I guess that is some serious distress. I just wonder of the depth of it.
And how, that's a good point.
There's going to be buyers on the other side. That's all I'm saying.
Yeah, and the sadder thing would be all it does is it doesn't create opportunities. It just costs investors more money. They don't put that and sell it for cheaper. the pain is just below that threshold of where it's breaking, cutting loose, and there are sponsors that are like, oh man, I should have sold that a year ago.
Yeah,
things were just the same a year, but I should have sold it a year ago. Who knows?
I haven't heard you guys talk about this, and I really haven't thought about it till now. It just popped in my head, but I wonder what the thought process would be in the mind of an LP of should I fund this capital call or not? Of what kind of math you should do and look at the project.
I was just thinking about that because like the investor, I was thinking about in terms of the syndicator, like should I put out a capital call or is it should I just say now there's like some emotion, but that's a good point. Should I fund this capital call or not? When do you need to kind of cut it loose?
Yeah, and it's not necessarily. I mean, not all capital calls are like signaling something catastrophic or horrible. I mean, sometimes it's just like a little bit extra money here. This thing turns around and it works out. That's fine. But I just wonder, every property and project can be a little bit different. But
now I'll have to ask Spencer. But if you don't fund that capital call, it doesn't mean that your original investments forfeit. Let's say
you just get diluted.
Yeah, so you would get diluted. Oh man, okay.
Yeah, so you'd have to weigh if that's worth being diluted. You don't want to throw good money after bad.
Yeah,
and it's kind of like I don't know how much faith probably you have in the sponsor, I guess.
Yeah. And it's a good point, and this was underscored. Even though Freddie Mac says our outlook for the U.S. economy is positive, and even in the housing market they said, now I like this. Unlike last year when many were anticipating mortgage rates would decline, in early 2025 the prevailing sentiment is that rates will stay higher for longer. And guess what? This may impact prospective buyers and sellers. And this year, they may make a move earlier as they're not expecting rates to go earlier. So that would increase home sales. Maybe higher rates make people think, oh, I think they're kind of twisting themselves in knots a little trying to say things are right. But their underlying expectation, and they're reporting this too. Wow, that's different.
I wonder who they were talking to when they said, unlike last year, many were anticipating mortgage rates would decline.
Yeah.
Almost every investor that I talk to are not anticipating mortgage rates to go down significantly really at all.
Yeah, we're not last year, you mean?
Yeah. Not even last year. Yeah. I mean, maybe we're just around the people that are more cynical, but we're like, no, these are, we've thought that they were going to be higher for a long time now.
Yeah, I know. And that is what I was kind of wondering is, along with the kind of technical effects of loan maturities, and interest rates would have to be long enough to capture that loan maturity, whether if it's a bridge loan with variable interest rates. Maybe it takes like a couple of years for people to realize, like, all right, this is where we're at. I can't expect anything new.
To come to the realization of it.
But who knows? That is the report from Freddie Mac. And I also wanted to note here, just as a little bit of an extra thing, consumer confidence has retreated in January, according to the Conference Board. Now, they say that their optimism about future and past, present, all went down just a little bit. I want to put this in a little bit of a context here. Right now, consumer confidence seems to be hovering around the same point since 2022. You look at this, it's about, their index has, it's essentially kind of arbitrary, but it goes from like 20 to 140, and right now we are at like 110-ish, and we've been between 100 and 120 since 2022. So that is about the level. We're hovering around the same level. It's fairly volatile. It can be up one month and then down the next month, but it has clearly shown this plateau since 3 years ago, since the beginning of 2022. So that's one thing. It's a little bit abnormal to have the length of this plateau.
Not going in any direction.
Yeah, not going in any direction. Yeah. And also worth noting is it's a little bit higher than it was in 2014.
Consumers can't make up their minds.
Consumers can't make up their minds. I know. Well, I have a bone to pick with some of these survey responses from the Conference Board, because Michigan consumer sentiment a lot clearer in terms of the general trajectory.
This is the opposite graph.
This is consumer sentiment, consumer confidence, call it what you will. I think they're asking very similar questions, or maybe they're tinging it differently, because this one seems like there's an optimistic trend. Whether it's long-term or the near-term, things have been improving. Yeah. If you're taking calls from Michigan, that's what you think. But then if you're taking calls from the Conference Board, you think things are a little bit different. Case in point is their inflation expectations. The Conference Board has inflation increased their expectation, 12 months, prices going up 5.1%. That's all the way to, they actually increased to 5.3% in January. So that's where they're at. And if you look at, now I don't have the chart for the inflation expectations, but Michigan, their 12-month expectations are 2.7%, lower, more reasonable, especially considering that this last CPI had us at 2.9% inflation. So I will rhetorically ask, which one of these sources, the Conference Board or Michigan, is a little bit closer to inflation? I think that U of Michigan kind of gets it right a little bit more. I think there's a little more reactionary stuff in whether it's the respondents or the questions or whatever. You see more volatility in the consumer confidence index and less of a clear path. However, it doesn't mean that people aren't a little bit shaky.
Yeah.
Things are getting a little shakier.
My take from all this is that you can basically be validated for whatever your existing opinion is on anything in Google. It's like, if you're more pessimistic, or maybe you're more towards like the Conference Board or something like that, is you Googling things or
pick your source
calls like this, and so you can kind of be validated, depending on whatever your outlook is in any way.
Yeah. That's good. I hope for a clear trend, and sometimes there is a clear trend that's kind of agreed on in different sources. But it is kind of helpful to put things in context across one platform. So, for instance, maybe things are doing a little bit in terms of their expectations and their sentiment, whatever. Maybe people are feeling a little bit worse than they were in the years preceding, but they're feeling about the same as they did in 2014, 2015, 2016.
I wonder how this changes too as you're interviewing different generations.
Yeah. The age is for sure. Michigan has a good breakdown of that too. There's party affiliation. There's all different
Gen
ways.
Z versus millennial.
Yeah. So that's it for consumer sentiment and for Freddie Mac's excellent right up there on the economy. Let's move forward to Fannie Mae, which arguably is a little more optimistic.
Wow.
At least their data on the multifamily market shows a more compelling sense of progress, at least from the perspective of like multifamily operators, if you're looking for strong demand. Their quote is, "We have upgraded." Let's scroll down to the bottom because this is their ultimate conclusion. "We have upgraded our outlook for the national multifamily sector to improving for 2025. We expect the multifamily sector will see slow but continued improvement in demand this year, possibly resulting in flat rent growth and slightly rising vacancy during the first quarter due to the new supply. But then after that period, we expect multifamily fundamentals will strengthen, moderately increasing rent growth and stabilizing vacancy." There are other sources that we'll talk about here briefly that show improving vacancy. That is to say, in vacancy going down, things are less vacant, things are more full up with renters. There are also other sources that maybe have another. They don't say moderately increasing rent growth. They're like, no, it's pretty close.
Well, this is ultimately Fannie Mae expects year-over-year rent growth could be between 2 and 2.5%. I mean, that's a pretty solid take. I mean, that's nationwide.
Yeah, nationwide. That's their call for the end of year, and that roughly is similar to a lot of the other rent growth forecasts and whatever from like RealPage. I think they had 2.8%, and Yardi Matrix may have had like 1.8, 1.5, I forget, but well within the range. Definitely not zero, and it's positive.
Or negative.
Yeah, or negative for sure.
Many markets have seen.
I mean, what's interesting too is we just didn't have time to cover it. Today's Apartment List had their most recent, kind of just released yesterday. Their rent growth report showed negative 0.5 rent growth.
Yeah. So
that was there, and that's the lowest. Comparatively, RealPage had rent growth at 0.5%. CoStar had at 1%. This is last year. 1%. Yardi at 0.6.
So Fannie Mae was the most optimistic of all of these?
No, actually, that's measuring the past year of rent growth, and Fannie Mae had at 1% as well. But their forecast is actually roughly in the middle of a lot of these, maybe slightly above, considering that Yardi Matrix may come in below 2% slightly. But I really like the chart. So moving on, kind of to specifically multifamily supply, which is expected to be has been and will be a driver of rent growth and multifamily performance.
Yeah.
It shows the
wow, look at this. Yeah.
New construction, how quickly it's falling off. You go to 2005 Q3, Q4, Q5. So basically heading into early 2026, late 2025, you see a fall off in multifamily completions that's just as, it's as dramatic as can be.
It kind of seems like this might be the theme of 2026.
Yeah, you're right. I think I'd misread before. It looks like the fall off in multifamily completions is pushed a little further into early 2026, but it is there, like it's very convincingly so that it's there, with completions projected as low as it was maybe
2012.
Yeah, 2012, 2015, depending on, whether you're at the, there's one quarter in every year that seems like it's the lowest, and I think it's Q1. So, and that's their Q2. So we'll see what happens. That's it could get lower as the month progresses, or as 2026 progresses, and that's saying that. Also noting the fall off in permitting as well. They've got rent growth, they've got concession rates here, some nice share of units offering concessions that have been elevated, but all in all, they really just expect. They expect some strength in the multifamily market, stronger rent growth. They have really put a pin in this idea that the supply wave has crested. It's pretty convincing, especially as we will see. We'll see some permitting numbers from I think it's Marcus and Millichap, and those are really convincing, showing just how much they've fallen off, really significantly here. And then there's a nice chart also on how variable the performance is going to be for multifamily assets, depending on where you are, what region you are, what city you are, and I think that has directly something to do with how much supply have they gotten. I'd love it if they sorted this by percentage of new supply, but
there's a lot going on in this chart.
So they have a little diamond symbol here to indicate how much percentage of market. So a place like Austin, which we've oftentimes talked about,
25%.
Above 25% of market is completed. I think let's look. See, it may be in a 5-year period of time. But regardless, the relative Austin is the most.
It's 23, 24, and 25.
So okay. So in 3 years, above 25% increase in apartment supply for Austin. Kind of no surprise, but I'd like to know if there's any regional differences. A place like Chicago, below 5%, maybe below 2%, but that's because Chicago's such a big city. However, they're not really building that many new ones.
Austin's a pretty big
New
city.
York, Austin's pretty big.
We actually had an investor that said that we should start looking at the suburbs of Chicago, and that there's some good growth prospects.
Yeah, it is, and that's a good point too. Any of these cities, you can look into submarkets in certain areas. It's not all a blanket statement. However, it does give you a good sense of what is likely to be seen somewhere in Salt Lake City, for instance, versus maybe Kansas City as another example. But my point in here, you see all these dots that are all across this graph here, showcasing how much different each of these markets had in terms of how much supply they've had in the last 3 years. I wonder if rent growth, vacancy, whatever, the chance that you'll find an apartment from a renter's perspective, that's going to differ even more in 2025 than it did in 2024 as we kind of finish grappling with the new construction wave, and especially as maybe the wave of new construction activity is elevated and then it comes off, and it comes off last maybe in like the Sun Belt where it hit the hardest. That's the wave is going to recede the last in those markets. So that could result in more divergence. However, nothing ever dramatic happens, right? But yeah, we'll kind of see. It'll be really interesting to see if the places in the Midwest and the Northeast continue their kind of spot among the top markets for rent growth and multifamily performance in the nation. All right, so let's close out what I think is a really successful episode of the Gray Report, and I thank you, Blake,
Thank you for having me on.
for coming. We're not done yet, but I do just want to I'll also take this time to encourage you to subscribe, follow, click our comment if you want, like us, do anything you can to boost those engagement numbers. Call a friend, even if it's if you don't like what I'm saying and you have like something you want to yell at me about. Last week I got yelled at because I said juggernaut instead of juggernaut. And so, like, there was a little confusion there, and I do apologize. I
can see how that would
juggernaut.
Someone got you in the comments?
Yes, I got me.
They're
And
not
you know what?
let that slide.
I did not. I didn't argue with him, and he made it. I listened
Did
to
you
it.
reply to him?
He was
Say,
right.
"You
I
got
said,
me"?
"You got me.
Good.
You're right.
Good.
Thank you. This is how I improve."
Yeah. You posted that, right?
Yeah, oh, definitely.
Okay,
I did.
good.
All right, so let's close out with this Marcus and Millichap report. Now, it is 69 pages long. Most of the parts of the report are individual markets. I do want to just go over their national stuff, but we get a cool, for people that like to download these reports, the link of which will be in the show notes. But yeah, people like to download this. There is a really cool statistical summary here. Lots of stuff jam-packed in here where it lays out for all of the apartments, just like at a glance. You can see their employment growth. You can see their completions and their vacancy rates, or their price per unit, and on all this stuff just right there. I tried to copy and paste it into Excel. Didn't really work. I tried to get ChatGPT to do it, and it said I ran out of credits for translating things, so I'm still working on it. But I bet you could easily, put this into Excel pretty easily, and you could figure out some rent growth and stuff on some really cool ways of manipulating this data. Really awesome that they provided it, that Marcus and Millichap provided it. Also, they have really cool ideas in the report.
Like what?
Their ideas about the multifamily market in general. So very similar. Supply wave has crested. Outlook is for improving vacancy, improving rent growth numbers. High interest rates made it difficult, are going to make things difficult. It's stuff that we've already talked about. But it is really, really worth noting here that they kind of aren't pulling their punches as much as they did maybe last year. I always remember Marcus and Millichap's trying to paint a good face on things and really optimistic. Therefore, things are going to be great. But they are unafraid to say things like, what is it? The prospect of abating headwinds really captured. No, they said, sorry. There's some crosswinds. There's some crosswinds, tailwinds, and headwinds. And
I've heard of crosswinds.
Yeah. We've heard of that as well. No, but it's not all sunny. They say that interest rates could really shake things up. Specifically, in the economy, inflation may make things a little more dicey when it comes to investing. And they also note many institutions moved to the sidelines. Several spent that time repairing their portfolios. Looking forward, many of the major investment funds will need to put their dry powder to work. I don't think so. This is what I wrote in the notes last night when I was thinking, dry powder is supposed to be explosive, right? It's not really exploding. I think you could probably shake that whole barrel of dry powder. Nothing's going to happen to it.
Yeah.
So maybe a better metaphor in that case. But I don't know about this re-engagement from major institutional investors. I'm not sure if that's going to happen, or if the force is going to come from private or smaller folks that are maybe quicker to move and better able to recognize specific opportunities rather than kind of large movements. So moving forward, they have some notes on in-migration. It's not a big surprise that everyone's moving to the Southwest, to the Sun Belt. It's really great, actually. It's good for those markets, and it supports their ability to kind of deal with the influx of apartment supply. So that's not really a big emergency on that point. I do think so. We've got another wild card here. So this policy uncertainty, also a wild card, and this soft landing strategy. So here's the crosswinds here. As the Federal Reserve aligns their policies to reduce inflation while sustaining modest economic growth, crosswinds could impede their headway. This is like a lot about the policies from the Trump administration. I think that, again, there's just huge question marks there. I think that it might be more accurate to think about overall inflation pressures, whether they're from policy, whether they're from from just more economic activity, and could that drive high interest rates? That's the wild card, and that's what they continue to kind of mention out throughout this Marcus and Millichap thing as well. It's not perfectly great, but there is like a lot of good to mention. So you see here, and I'm going to try to zoom in on this. It doesn't even get pixelated. And you see that inflation, it continues to taper. You've got, whether you're talking about CPI, PCE, or core, it's continuing to go down. Maybe recently it's jumped up just a little bit, but the long-term trend, I think, I'm not willing to give up my expectation that inflation could continue to. Now, if it stays like this for a couple more months, then I will ditch my hope in lower inflation. But these are I think these are the crosswinds or headwinds or whatever, is this effect on inflation. They didn't, let's see here. I don't think they mentioned too much about, okay, so at the same time, challenges including low income, household financial distress, record consumer debt, and continued labor supply shortages could restrain the economy. Labor supply shortages or, this hiring slowing is also something to work to, that's one thing that is like, it's a little bit of a counter worry. Like inflation, you'd think is a time when hiring is up and a lot more economic activity. However, there are some signs here, especially like these continued lower jobs numbers over the long term. That's a little bit worrying and maybe a counterforce to the general inflation. I know that last month's jobs numbers were above expectations, but that longer term trend is for a little bit more worries for the labor market. Now, I know we covered a little bit about the debt market and sales activity. Now I wanted to show this chart that I had pointed to and referenced earlier in the Gray Report, and how this transaction activity is about as low as it was in 2012. Definitely not as high as it was in 2022, but it's not like half of what it was, just really low. And if it's another year of this, that's not great. And then in the following page, we get some interesting stuff about permits. Now, this is the one that I thought, I haven't seen these compared like this, and especially, whether it's market by market or if it's just like this national or regional averages. Permit activity is going down. This is why we just talked about all the Fannie Mae expectations for lower apartment supply in 2026. It's because the things that happen when you start apartments, like getting a permit, those are down a lot. It's funny, you see this big this big gap between the completions are at higher than they've ever been, and permits are lower than they've ever been. Not lower than they've ever been, but quite a great deal lower. Now, I will say, though, it looks about a little bit the same as they were in maybe mid-2020. I don't have the numbers here for pre-pandemic, but this may just be settling back to a normal. I think it's going to be well below normal, because some of this change in permitting activity is really drastic, especially in, let's say, Nashville is 60.5 fewer permits now than a year ago. For Jacksonville, it's like almost 79%.
Wow. And
Salt Lake City, 61%. Those are the big ones. Really crazy. Austin, negative 7.4. Not as much.
They're still building.
But they really are.
They're still going.
Man, so that's going to be interesting. And this is super interesting. Phoenix, which is maybe expecting 3,500 more deliveries next year, their permits are down about 20%. Same thing for Charlotte. They're going to get more deliveries, about 4,000 more in 2025, but their permits are down. So you see, this just shows, and this is an awkward way of me of trying to explain how the apartment supply wave crest. Sometimes in some cities, it crested last year. In some cities, it's cresting this year by a lot, up 4,000 for last year. And then Nashville, it's going to be down 4,700. Right. And so it just depends. And that could lead to a starker difference between different markets. So there are reasons for strength. There are reasons to be afraid if you want to be afraid. I think that, Blake, that you put it correctly. It's going to be a normal year where if you want to make money, you probably have to work at it.
Yeah.
And that's reassuring. And we will see, if on the investor side, if investors get more discerning, whether it comes to sponsors, assets, markets, et cetera.
Yeah.
My hope is that actually people will continue to be confident in multifamily as an asset class. But there may be distress, and it may, for as many people as it may, kind of harm, like people are going to lose money. There could be opportunities that come out of it for investors and buyers. And I don't want anything ever to happen bad to anyone. So.
Yeah, I think so much of this is looking at such a narrow time frame. I think real estate's all about the long game. And if an investor has like a long-term mindset on this, as we do, 10 years from now, like real estate's going to be worth more than it is today.
Yep, true.
Fix the debt if it works today.
Oh, like John Chang says, keep your eyes on the horizon. I can't do that, but don't clip that out.
Trademarked?
Don't clip that out because he will come knocking on my door. John Chang, you were invited to Gray Report if you want to come. Sorry.
But yeah, if you can fix the interest rate today, get with a good sponsor in a growing market, and have a long-term view on real estate, I think you're going to be largely good.
And that's kind of what you were saying. I think that totally makes sense. It's like, if once you acknowledge and factor in the difficulties that we're pretty sure is going to be, like no interest rate savior is going to come along. All right, with that in mind, there's still a pretty good case, a better case, much better than last year. All of the rent growth expectations are significantly more than they were last year. So stories about it being all the same ignores like a really fundamental driver. And so I'm going to be really interested in what Spencer says is kind of the prevailing sentiment, investor sentiment, how if it has changed in 2024 to 2025. But thanks so much, Blake. Do you have any other final thoughts or assessments, expectations for the market? Oh, do you want to tease and promise everything? Gray Capital has a deal that we're working on and we can't say anything about.
Guaranteed returns.
No. You save that for your investor relations calls.
Oh, no. These returns are personally guaranteed by Matt Bosnagel.
This is when the disclaimer graphics should be. We do have a deal that we're working on. That,
are we allowed to say that? When's this coming out?
No, I don't know yet.
Okay.
We can't say anything about it yet, but we are very excited about it. We've researched the heck out of it. It is one of these ones where I think it did reward diligence and just nose to the grindstone kind of stuff.
Without teasing too much, I feel like this asset that we have coming up shortly is probably one of the best projects that we've ever had for a first-time investor. Yeah. It is very straightforward, easy to understand. Great asset, great location. There's not too many moving pieces, and so for that reason, I feel like it's a step down on the risk spectrum. Yeah. And still has really good risk-adjusted returns. And so for those reasons, I feel like for a first-time investor or either you're a first-time Gray Capital investor or first-time LP in any sponsor's real estate deal, I think this deal could be really good.
Great-looking building.
Yeah.
Growing market.
Yeah.
I don't want to say anything more because of we described this a couple weeks ago in the Gray Report, how there are certain moments and phases of a multifamily syndication where you're working on the deal and you can't share it with anyone. We will hopefully be able to share more detail soon. Suffice to say, we are very excited about it and watch this space. All right. Well, thank you so much. Thanks again, Blake, for being on the Gray Report. And if you want to subscribe, comment, whatever. Or you can sign up to the Gray Report newsletter. Comes in twice a week, Sunday and Thursday in your email. It's free. Go to www.graycapitalllc.com/report. You get that right in your email.
And if you want to troll Matt in the comments, we also welcome that.
Yeah, definitely.
He welcomes that as well.
I do too. And if you're right, then I will. But if you're wrong, then maybe I'll say, yeah.
Fight in the comments.
All right. See you next week. Thanks.